Hello guys, how's everyone doing? Well, I don't really know how everyone's doing because I can't see the chat right now, but I'm gonna have a quick look at the chat. Can everyone hear me okay? I just want to do a quick sound check and then I can continue. All right, nice. Cool. Well, let's get started then. I haven't got much time tonight. I am leaving tomorrow for a snowboarding trip. So yeah, I haven't got much time. I want to get to bed early. I got a very early wake up tomorrow. Very early wake up. So I want to get as much content out to you guys in this hour as I possibly can. We're going to be doing a brief Q&A, but we'll get to that in a second. So what are we going to talk about today? What will you learn? Well, you're going to learn a simple and powerful framework for entering trades. So when I say simple and powerful, I mean it's easy to remember and use. It can be used for all strategies, not just mine. You might need to make some tweaks for certain strategies, but it should work for pretty much any strategy out there. So it's a simple and powerful framework for entering trades, and most importantly, it can be used for any time frame. Now, I use this same framework for entering trades on the 5 minute all the way through to the daily charts. Now, I see there's a few members who are here, a few Forex Mastermind members who are in here. I mean, you're welcome to stay, but you guys already know all of this because it's one of the basic lessons in the course. But yeah, you're welcome to stay. Hello, Aaron. I see you're in here. JT. There's a bunch of you guys. Boris too. But anyway, it doesn't matter. Yeah, it's a bit of a recap, isn't it? All right, cool. So let's get started, guys. So you're going to learn a powerful framework for entering trades. You're going to learn how to play smart, safe, uh, basically stops that are hard to hit, safe stops that are hard to hit. And that's very, very important because a lot of traders blame their stops being hit on stop hunting. And while stop hunting does technically exist, it doesn't exist with regulated brokers. And banks, they don't set out to take out the stops of retail traders who are trading $1,000 accounts. Banks don't care about that. Banks don't even see your orders. A lot of traders, they don't take responsibility for the mistakes they make. They blame it on stop hunting, they blame it on whatever. But the reality is, if your stops are getting hit often, and if your stops are getting hit by just a few pips, then that probably means you're placing bad stops. And I'm going to show you how to place safe stops, smart stops, and stops that are hard to hit. I'm going to show you how to place smart targets, safe and easy to hit. Ooh, damn it. Well, that's stupid. I obviously, this is not supposed to say stops again. This is just how it is with me, guys. I am not the most organized webinar guy. My webinars aren't polished, but easy to hit stops. Yeah, I'm going to show you guys how to place easy to hit stops. Wow, you all want to learn that. This is obviously supposed to say targets, not stops. I'm sorry about that. So we're going to show you how to place easy to hit targets and hard to hit stops. And yeah, we're going to go through a whole bunch more things as we go along. And also, we're going to be talking about how to enter trades at the right time. That's an important thing that I forgot to mention, how to enter trades at the right time. So let's get started, because by the end of this webinar, you're going to know how to trade safely, lose less trades, and win more trades. So that should be good. So before we get into the webinar, just a little quick intro into who I am. For those of you who don't know, my name's Nick Bencino. I'm the owner of forexfornoobs.com, which I started like 12 years ago. I've been trading for 17 years. I'm a pure price action trader. And yeah, like I said, I started Forex for Noobs 12 years ago, and I've been doing webinars and Forex education ever since. It's pretty much the first Forex price action site to ever exist on the internet, and I'm pretty proud of that. So let's go over some quick rules. Number one, the most important rule, don't be rude or disruptive. It's just simple. Don't be rude or disruptive. If you have a problem with something I say, or you disagree with something I say, I do not mind if you bring it up. I don't mind being called out, and I don't mind discussing concepts and ideas if someone disagrees with me. So I don't care if you disagree with me. I'm not talking about that. I'm just saying don't be rude or disruptive. There's a big difference. You can voice your opinion in a nice way, or you can be not nice. I don't like it when people are not nice. Just disrupts everything, doesn't it? So if you are not nice, you'll be kicked because there's a moderator in here today. Please keep questions until the end. I'm not going to be doing questions during the webinar. And number three, don't spam. So that means two types of spam. Don't spam products or websites or whatever. And don't spam to get my attention to get your question answered. Well, that sums up the rules. So let's get into the actual webinar. Oops, I skipped ahead one step, and I shouldn't have. So basically, what we're going to be discussing today is simple. Good stops are hit less often, and good targets are hit more often. So my own personal trading philosophy is pretty simple. I just like to place targets that are easy to hit and place stops that are hard to hit, while maintaining a good risk to reward ratio. Now that's the key. Place targets that are easy to hit, place stops that are hard to hit, but maintain a good risk to reward ratio. Because anyone can place a stop that's easy to hit a stop that's hard to hit and a target that's easy to hit. Let's look at this trade as an example, this AUD CAD short trade. If I want to place a stop that's hard to hit, I can stick my stop loss up there. It's going to take a long time for AUD CAD to get up there. If I want to place a target that's easy to hit, I can set my target there. Well, there we have it. A hard to hit stop and easy to hit target. Simple stuff, right? Well, obviously this isn't going to work out in the long term because every win you make or every loss you take, you're going to have to make like 30 wins just to break even. Not going to work out too well for you. So obviously you don't want to do that. So you need to be able to place smart stops that are hard to hit, but that are also and targets that are easy to hit, but also maintain a good risk to reward ratio. And that's what we're going to be looking at, that key factor, how to maintain a good risk to reward ratio while placing smart stops and smart targets. And how do we do that? Well, we use this simple process. I call it STEP, stop, target, entry, place. So we use price action to find a safe stop. We use price action to find an easy to hit target. And then we use price action to find the right entry point. Well, not then, technically speaking, we kind of do these first three steps all at the same time. Stop, target, entry. That all happens simultaneously. And then of course you place your trade. So this is all you have to remember whenever you're entering a trade. You have to remember stop, target, entry, place. And it's easy to remember because it spells out the word step. So just think about it as stepping into a trade. You're going to take a step to enter the trade, and then you remember the three components: stop, target, entry, place. But the question is, how do you actually do these? And that's what we're going to get into now. So it pretty much all comes down to barriers. What are barriers? What are barriers on a chart? Well, think about it like this. It's a good analogy that I like to use. It's a pretty simple analogy. This is you. You've gone out backpacking or hiking or whatever you want to call it, out in the wild, and you got yourself lost. You're out in the middle of nowhere. You don't know how to get home. You have two directions you can go because you live in a flat 2D world. You can go that way, or you can go this way over this big mountain. The mountain's not too big to you because you're a giant, but let's imagine you were much smaller. You're like that little dot there. Which direction do you choose? Do you choose to go over the mountain where it's snowy up there and dangerous and treacherous? Or do you choose to go across the valley where it's open plains, easy to get across, it's a lot warmer, it's a lot less dangerous? Obviously, any smart person would choose to go that way because that's the only thing that makes sense. Why would you go climb a mountain? You're just going to get yourself killed. Now, this is the way I like to think about a Forex chart. So this little thing here, this isn't you. This is a trade that you're taking. Now, when you're entering a trade, if your target, is behind a barrier, so let's say your target is here, what's going to happen? Price is going to hit that barrier and bounce away and not hit your target more often than not. If instead your target is over here with all that big open space towards it, price finds it easier to flow in that direction. Therefore, it's more likely for your target to be hit. So whenever we're looking at a chart, this is the way we have to think about it. We want to place our target in front of barriers. And more importantly, we want to place our stop loss behind barriers, because our stop loss is something we don't want to see hit, essentially. I mean, it's pretty simple. We don't want our stops to be hit most times. Well, all the times, really. So we want to place our stop loss behind barriers, because once we place our stop loss behind barriers, it's less likely for it to be hit. But what are barriers? Well, I don't know why I have that there. These slides are pretty poorly prepared. I'm sorry, guys. I'm really bad at making slides. So what are barriers? Barriers are areas of support resistance, recent highs and lows, recent areas of congestions. Oh, wow. This is just embarrassing at this point. I've made so many mistakes in these slides. Like I said, guys, I'm preparing for a holiday. I'm off tomorrow. I was kind of in a rush to throw these slides together. I'm sorry for all the mistakes. If you guys attend my webinars often, you know I'm not the most organized in terms of webinars, but my slides never have this many errors. But recent areas of congestion, they're also barriers, and historical highs and lows. When I say historical highs and lows, what do I mean? I mean yearly highs, I mean monthly highs and lows. So when price is at a point that it hasn't seen for several years, that is a significant barrier. And we want to place our stop losses behind those barriers. We want to place our targets ahead of those barriers. You don't want to place your target beyond a yearly high if you're going long. You don't want to place it beyond a yearly high, because it's very likely going to get stuck at that yearly high. So let me show you some actual real examples. Actually, no, let's start with this example. I think this example is better. And then we'll switch to some real examples. So for those of you who know my strategy, which I assume most of you do, this is a resistance area. This is a resistance area. This is a support area. These are barriers on our chart. Now, let's say we want to enter a trade short here. We're trading in this direction. We're trading short. Where would be the most logical place to, assuming our entry is here, I'm going to give away the entry point. So let's assume our entry is here. This is the entry. Now, where's the most logical place to put our stop? Is it here? Definitely not. Not only is that an incredibly tight stop, but also it is in front of the barriers, or it is inside of this barrier, and it is in front of another barrier. The other barrier is that recent high. So there are two barriers here. There's a recent high and there's a resistance area. This is the resistance area and this is the recent high. So we want to place our stop loss beyond those two things. We want to place our stop loss at a minimum. We want to place our stop loss up here. That's our minimum stop. Now, like I said, our entry would be here. Now, what do we do with our target? It's always nice to have a big target, isn't it? It's always nice to make a lot of profit on a trade. But where's the smartest point to put our target? Now remember, we can always extend our targets later depending on how a trade is doing. I'm talking about our initial target. When we first look at this setup, where do we place our first target? Do we place it down here? No, because support is a barrier. So when price hits support, it's very likely that it's going to start bouncing away. So it makes more sense to place our target before the next barrier, before support. Place our target there. It's way more likely to get hit. Now this is especially true in low volatility conditions. Low volatility, support and resistance areas become a lot stronger, and they're a lot more likely to hold price from moving through them for extended periods of time. High volatility markets, you get price crashing through support resistance areas a lot easier. But low volatility markets, which is what we're experiencing right now, and we have been for the past 2 years, we are in low volatility conditions in Forex, which is fine. It's actually better in terms of trading, but it also means price gets stuck on support resistance areas for longer. So we don't want to place our targets beyond support resistance areas. We want to place it in front of. We want to place it in front of barriers because this is a barrier. Now, like I said, we can always extend that target later. We can always extend it. You know, if we see that there's a lot of momentum and price is dropping down really fast, we can move that target beyond the area if we want to, if we believe that it's going to break through it. But initially, before we know how this trade's going to perform, we want to place our target in front of the barriers. And we definitely, every single time, want to place our stop loss behind barriers. Never place your stop loss behind barriers. There is no logical reason to do so. Sorry, never place your stop loss in front of barriers. There is no logical reason to do so. Stop loss always goes behind barriers. So this would be the ideal entry, stop, and target for this trade. And I know this looks like a tight target, but remember, like I said, we can extend that target. Extending targets is completely fine. But when you're first looking at entering the trade, this is what makes the most sense. You want to place your target in front of the barrier. You want to place your stop behind, and you want to place your entry, you know, around about there. So why is this slide stuck? Oh, it's probably because it's the last slide. Okay, let me get it off my screen. So now what I'm going to do is I'm going to switch over to some real examples. Now, when I'm showing you real examples, I'm actually going to take trades that I shared in the analysis over the last few weeks. So these aren't trades that I'm just like making up, or trades that I, you know, after the fact, I'm picking out these examples to show you. These are all trades that I shared in my analysis on YouTube, posted publicly over the last week or two. Maybe one of them was 3 weeks old, but most of them are within the last 3 weeks. All trades that I've placed. Sorry, not I've placed. That's not true. I didn't enter all of these trades. I shared them, but I've been very busy lately, so I've missed a lot of my own trades. But I shared them publicly, and a lot of my students entered them. A lot of people who watch my YouTube channel entered them, and they were posted for free. So it's all out there. You can just look at my YouTube to confirm that these are actual trades that I shared before the fact. So I'm going to show you some failed trade examples and some real, some profitable trade examples. So this is the best way to learn, really. I mean, showing you a picture like I just did is a decent kind of way to gauge what I'm talking about and to kind of get a basic understanding of it. But looking at some real recent trades is the best way to understand this concept, why we want to place our stop in front of barriers, why stop behind barriers and target in front of barriers. So let's delete this for now, and let me explain the setup itself. I won't go too deep into explaining the setup because this isn't really, we're not really here to talk about my strategy or my methodology for wanting to enter the trade. We're talking about how I enter the trade. And this basic methodology for how I enter the trade, or the framework for entering the trade, the step framework, can be ported over to any strategy. So it's we're not here to talk about my strategy, but I'll just give you a basic rundown of why this was a trade. So what we had here was we had a bullish proceeding. It's hard to call it a trend. I call it a trend. It's probably not the best use of the word trend, but let's just say it's a bullish proceeding move into an area of resistance. Once it hits that area of resistance, it stalls out, and then after it stalls out, price starts to turn around, and the entry for this one, I'll spoil the entry because the entry is like the simplest part. The minimum entry requirements I have for my trade is price making a new low beyond this candle here, which I call the indecision candle. So whatever your entry candle is for your strategy, doesn't really matter. For me, this indecision candle indicates that the trade is ready to go, and then I enter on the next candle. So the entry itself is placed as this starts moving down, not after it closes, as it starts moving down. So after this indecision candle here closes, I start looking to enter the trade. So where does the entry go? The minimum requirement I have is a few pips below the low of the indecision candle, which would be around about here, where you see this black line here. So entry taken care of, that's where we want to enter this trade. Now we have to decide where to place our stop. And this is where the kind of step framework starts to unfold, or starts to be used. And this is where we have to start thinking about barriers. So when I talked about barriers, what did I say? I said we want to place our stop loss beyond recent highs or lows. In the case of a short trade, we want it beyond recent highs. So this is a short setup. We want to place our stop loss beyond recent highs. So those are some highs there, but there's also some highs here. The more highs we place it above, the better, because highs are barriers. These are all barriers, right? This highest point where price reached, that's a barrier. So we're going to try to place our stop loss beyond that barrier. We're going to place it beyond the barrier created by these highs here, which is another barrier. So that's where we want our stop loss. We can't necessarily have our stop loss there, but that's where we want it. Now, where does our target go in this example? Should we place our target here? No, that would make no sense really. Should we place it here? No, again, that wouldn't really make much sense. Our target can go, let me just move this and zoom in a bit. Yeah, that's better. So our target can go in front of barriers. So let's look at some barriers in this example. Where are the barriers in this example? So the first barrier is our support area. Now, if you don't know how to place support resistance, just refer to some of my other videos. I'll link in the description my other videos where I talk about placing support resistance. These support resistance areas are pretty straightforward to place. I'll show you how to place them. We're not going to talk about how to place them now because that's not what we're here to talk about. We want to place our target in front of this barrier. That's the most important part. We don't want to place it beyond that barrier. We want to place our target ahead of this recent low there, right? Because that low, just like the highs, that low is a barrier. So that low is the lowest point price has reached recently, and it's a barrier. And what happened when price hit it? Today, boom, it turned around. This trade was shared before today, and I think a lot of people entered it on the forum. Should double check that. I don't want to lie. AD card. Well, a fair few people entered it. I wouldn't say a lot. But people entered it on the forum. I can't remember where I was, but point is, we want to place our target ahead of barriers. So we have the barrier created by the support area. We have the barrier created by these lows, and there's another barrier here, which is this area here. Now this is congestion where price kind of bounced away from, but to be honest, we can't really place our target ahead of that barrier because it's going to be a tiny target. We're not going to maintain a good risk to reward ratio. Remember how I said maintaining a good risk to reward ratio is very important? I like to maintain a minimum risk to reward ratio of 1.5. That means my target is 1.5 times the size of my stop. But that's the minimum. I prefer to get 2 when I can. So placing our target here ahead of this barrier, not going to work too well for us. So we'd place it down here. That's going to give us a risk to reward ratio of 2 while maintaining a safe stop loss that's beyond all those barriers. And our target's going to be at a risk to reward ratio of 2, which is nice. And it's going to be ahead of barriers. So that is a good target, a good stop loss, safe stop loss. And that's it. That's what we're doing. So when we look at this trade, we do the first 3 steps together. Stop, target, entry. So we look at the stop, the target, the entry. That all is done together. And then we place the trade. Or we place the pending order. And in this case, using this basic methodology worked out pretty well because had you placed your target ahead of this support area and had you placed it ahead of that low, it would have got hit and price would have turned around exactly. Now, look, this week we've had several examples where it kind of worked out perfectly. It's not always going to work out like this. It's not always the case where your target gets hit by a few pips and then it turns around. You know, that it's not always going to work out like that. Sometimes it's going to go 20 pips beyond your target and then turn around. Sometimes your target's going to be hit and price is just going to keep moving down. And had you held the trade for longer, it would have made you more profit. So it doesn't always work out so perfectly like this. But this is a good example of why we do it like this, why we place our target where we place it. Because especially in low volatility markets like we're experiencing right now, placing our target ahead of those barriers is going to ensure that price doesn't have to contend with a heavy support area or make new lows in order to hit our target. So yeah, let's look at New Zealand CAD. Here's another example. Just want to quickly check the forum and see how many people entered this one. Oh, this one was a lot more. This is the one I was thinking of when I was saying a lot of people entered it. It's the New Zealand CAD one a lot of people entered, not the AUD CAD one. A few people entered AUD CAD, a lot of people entered New Zealand CAD. This one was a popular trade. Right, so let's talk about this trade in a bit more detail. So we're using the same basic methodology here, and it's the same basic setup. I shared this trade, I think, in Monday's analysis session, or it might have been last Thursday's analysis session. I think last Thursday... Oh, what was last Thursday? Let me look up the date. I think last Thursday I shared this here, and then it came back up to it again for a second attempt. So yeah, I probably shared this one on Monday, this specific one here. Anyway, I can't remember the exact details. It's not important. What's important is I shared this in my YouTube analysis. So let's look at this setup. Let's break it down a little bit and kind of analyze exactly what's going on here. So we have a move up into a resistance area. Now, this was a pretty strong setup. Why was this one a strong setup? Because price is ranging here on New Zealand CAD. So price is stuck in this, that's a horrible color because it can't be seen over those candles. Let me change the color of this arrow. So we can see price bouncing in this range. Price is stuck in a range. When price is stuck in a range, it's the easiest time to trade. And this year, price is going to be stuck in ranges a lot because we have low volatility conditions. What did I just say 10 minutes ago about low volatility conditions? When there's low volatility, price gets stuck on support resistance areas. When price gets stuck on support resistance areas, you get ranges because price hits support, bounces away, hits resistance, bounces away. See, it's finding it hard to break those areas. So we're getting those ranges. So it becomes pretty predictable, that pattern, and traders can follow it by shorting up here. Now, that's why this short here was a trade I shared, because it pushed up to resistance. And George, can you double check for me that I shared this trade in my analysis? I think I'm confusing two things, and I don't want to lie to people. I think I shared this one here, but I didn't actually share this one here. I think this one was shared by someone on the forum and not by me personally. It doesn't really matter, but can you just double check for me, please? But yeah, it doesn't really matter. The point is, it was shared to the forum, so it's one of my trades. And we're using the exact same concept here. So our entry is placed a few pips below the low of this candle, which is here. Our stop loss is placed a few pips above the highs of these recent candles. See these recent candles here? We want to place our stop loss above those highs because that's a much safer stop. We want to place it above those barriers, and we want to place it above resistance. So this is the resistance area. Our stop is above there. Our stop is above these recent highs here. That's a safe stop. That's a smart stop. We're placing it behind barriers. When we place our stop loss behind barriers, it's easier for it to get hit. Where do we want to place our target in this example? Do we want to place our target down here beyond this barrier, this resistance area, support area rather? Do we want to place it beyond that? No, we don't. We want to place it ahead of that, so here. But if we look to the left, we see that last time it pushed down to here, it started stalling out here. So if we can, we want to place our target ahead of those lows because those lows represent another barrier. So we want to place our target ahead of those lows. We can place our target ahead of those lows and maintain a risk to reward ratio of 1.7, which is acceptable. Not as good as 2, but it's acceptable. It's acceptable. And placing our target there would have resulted in a winning trade, and then it would have turned around and started moving back up to resistance. Now, once again, there are a lot of examples this week with this week's trades where it kind of worked out perfect and price just hit the target and turned around. It's not always going to be like that. Now, if we go back to this trade here, which was not as successful, we're using the same basic methodology. Entry here, stop loss above the highs. So our stop loss is placed above that high. It's placed above resistance, above that high. That's where the stop loss is. Entry is placed here. If the target's down here, because at that time, we did not have these lows as barriers. So our target would have been lower than that. Our target would have been just ahead of this support area. So in that case, you can see it would not have been hit and it would have turned around. So it's not always going to be a profitable trade, but that's just the reality of trading. You're not always going to be profitable. So in this specific case here, you would have probably gotten out when price pushed back up to your entry. But then following that methodology on the next trade would have worked out quite well. I know there's a lot of weird currency pairs here that not a lot of people trade, like Euro New Zealand and New Zealand CHF. But it was just a bit of a week where the cross pairs were giving us good trades. We trade all pairs. Last week the cross trades were pretty cool, so that's where most of the trades happened. Euro New Zealand, I guess, is a decent example. It's not quite as good. We'll come back to that one. New Zealand CHF. Now, this one has a lot of New Zealand pairs this week. Use this tool. So, again, here we have a very simple example. Price hits an area of resistance, it stalls, starts turning around. The entry is placed here, just a few pips below the low of the indecision candle. Stop loss is placed above those highs. Now, in this case, the target has yet to be hit. So this would still be an open trade, although I think a lot of people have already closed this one out. Target is yet to be hit. It's still an open trade. But the target, in this case, the smartest target would be here. It wouldn't be down here. It wouldn't be down here. Obviously not beyond the support. I'm sure you guys get that. But we can see that low there. We want to place it in front of that low because that low is a barrier. So we want to place it around there. It has yet to be hit. But there we go. So that would be a still open trade. So I think it's probably sinking into you guys now how this works. It's not that difficult to understand. And this kind of stop loss and entry is designed to do two things, because one of the main actions of a stop loss is to stop you from taking too big of a loss. I mean, it's kind of hidden in the name, isn't it? It stops you from taking too big of a loss. It's a stop loss. So I've seen a lot of traders recently who are trading without stop losses, which is the stupidest thing you can possibly do as a trader. And it's going to equal you losing all of your account one day. This is a trade I took that resulted in a loss, but the use of a smart stop loss allowed me to get out without suffering too big of a loss. So this trade was entered similar methodology to the others, and I used the step framework in order to place my stop target entry price, stop target entry place. So stop went there, target went here at the support area, in front of the support area, entry went there. I'm sure you guys now understand why I would have done it like this. My stop loss went above the high of the indecision candle. My entry went below the low of the indecision candle. And my target went ahead of this support area. But obviously this trade didn't work out. Price broke below, entered me into this trade, then turned around and started pushing up and hit my stop loss. But the point here is that I placed a smart stop, a stop that would take me out when the trade had almost no chance of going in my favor anymore, without taking too big of a loss, without losing too much. So that's why my stop went there, and that's the purpose of a stop. And even though this was a failed trade, I didn't really lose that much. So, it's just another failed trade. It's just part of trading. If you can't handle a failed trade, you can't be a trader. I wanted to show you a few failed trade examples, because I don't want to just show you when this works out, because that's not really the reality of trading. I can't only show you winners. This was a trade I shared in Friday's analysis, I believe. And I've actually got a bit of an interesting story about this trade, which I probably shouldn't tell, but I'm going to tell it anyway. I'm not going to reveal any names or personal info of people involved, so it doesn't really matter. Now, I shared this trade in Friday's analysis. Thursday's analysis. Today is Friday. I don't know what I'm on about. I shared this trade in Thursday's analysis. And I said, myself, I am not used to commodity trading, because this is gold. This is a commodity. It's a spot commodity. So it's a spot. Spot just means kind of like a Forex. It's a Forex pair, but it is a commodity. So it is different. I have very little experience trading commodities, trading gold. So I want to start trading it. I want to get it into my kind of trading toolbox, or whatever you want to call it, my trade list. But because I have little experience with it, I decided I'm going to do a few demo trades for the first few trades. Then after those demo trades, after I get a feel for the pair, I'm going to start doing live trades with drastically reduced position sizes. Then I'm going to slowly increase my position size until I get more comfortable. Simple. I explained this and I said very clearly in my analysis, guys, if you do not have experience trading commodities, do not jump into this pair with real money. You know, whenever you're introducing something new into your strategy, you need to do it slowly. You need to think a lot about it, because the number one rule in trading, the number one rule every trader must follow, is to protect your capital. That's all trading is about. It's not about making money. First thing, well, it is about making money, but that's the second thing. The first thing is protect the money you already have. Because the better you protect the money you already have, the easier it is to make money. Because when you lose money, then you have to gain it back to then make profit. So protecting your capital is number one. Then protecting your capital is also number 2 and 3. And then number 4 is maybe make some money trading. But protecting your capital, way more important. So I'm very cautious. And when I shared this trade, I told everyone to be very cautious. I then got an email the next day from someone very angry saying, I followed your trade and I lost a bunch of money on the trade. And they got really, really angry with me. Even though I warned them for maybe 5 minutes in that webinar to trade this with care. Now, how much money did I lose on this trade? Well, 0, because I was demo trading. But let's imagine I took a trade with real money. Let's just imagine that I was experienced at trading commodities and I took this trade with real money. How much would I have lost with this trade? Not much. I would have probably risked 1%, let's say. Price would have moved down, would have hit my stop, would have taken me out of this trade. I would have lost 1%. So I got triggered in there. Price went up. Didn't work out for me. Whatever. Hits my stop loss. Boom. 1% lost. People who don't know what they're doing, they risk a lot more of their account and they put their stop somewhere like silly, or they don't use a stop at all, and then boom, price shoots down and they lose money. So, you know, never do that, guys. You need to protect your capital. Use your stop losses, and when you're placing your stop loss, you know, place it behind barriers. That's just the logical place to put it. You don't want to make your stop loss easy to hit, but you also don't want to make your stop loss so stupidly large that you're going to lose half of your account when it's hit. We have a bit more time. Let's look at GBP. No, what was it? The GBP AUD? Yeah, it was this. Is any point looking at this? Let's look at it anyway. I'll just give you a quick wrap up of this trade. I can't remember exactly when I shared this trade. It was probably around the end of January. So it was several weeks ago. But it's another trade I shared in the analysis publicly. And it followed the pretty much exact same simple concept. When the trade formed, price headed up to resistance, stalled out on resistance, gave us this huge indecision candle. Entry was placed a few pips below the low. Stop loss was placed above the resistance area, which is here. And then above the indecision candle's high, which was here. So above recent highs, above resistance. Our target was placed around about here. Oops, sorry. Around about here. Met the minimum risk to reward ratio of 1.5. That's the minimum risk to reward ratio. 1.5, so it was acceptable. And it worked out quite well. Now, initially, the target would have been hit. I mean, not everyone traded it in exactly this way, but I'm just saying, let's imagine someone traded it with this exact, with these exact numbers. Target would have been hit. It would have turned around. So the trade would have been closed out. Eventually, it did drop down a little bit further, but not much further, really. And then it shot back up anyway and turned around completely. It hasn't been back down there since. So you've seen several examples of real trades shared in the analysis that show you how powerful this simple concept is of placing our stop loss behind barriers, placing our target ahead of barriers. So do it. And if you're trading a strategy that's not my strategy, that's completely fine. There's a lot of profitable strategies out there in the Forex world. My strategy is not the only profitable one. You can use these concepts in that strategy. You could just kind of like port them over. You might need to do some tweaks, some changes, but the basic concept of placing your stop loss behind barriers, placing your targets in front of barriers, that can be used in pretty much any trading strategy. And also, like I said, it can be done on any time frame. I use this same methodology for the 5-minute charts, for the daily charts, and for everything in between. My stop loss always ahead of barriers. Always behind barriers. My target always ahead of barriers. Simple, easy stuff. So that's what I wanted to share with you guys today. Now I'm going to take a look at the chat and I'll answer some questions. Please keep questions on point, talking about stops, targets, entries, and stuff like that. We're not talking about other stuff. I do plenty of webinars on my strategy on how to spot trades, and I'll link those below. We're not here to talk about how to spot trades. We're here to talk about stops, targets, entries. But yeah, guys, if you have any questions, now's your chance. I'm just looking back on questions that were asked. All right. Yeah, I said keep it on topic. No one ever keeps it on topic. All right, let me see what we have here. That's an on topic question. Which indecision candle to choose? Kind of on topic. I'm assuming you mean for entries and stops. You just always use the lowest one. Let's say you're going into a short trade. Now, for a short trade example, I actually realize I don't have any long trade examples, do I? I don't think I do. I don't only take short trades. Long trades are also taken. It's just for some reason it's been mostly shorts this week. Other weeks it's mostly longs. But let's do this one here. This one's a good example. Now, here there are multiple indecision candles. There's pretty much two. So which one of these do you choose? Well, it kind of depends. First, if this candle closes here, then you've already placed the entry there because you're using that indecision candle. So you get triggered into the trade, and then this one also becomes an indecision candle. So this one triggers you in, but then turns into indecision. So you already have your answer there. You've entered on this one because this one was the first one to form. But let's say you weren't watching the charts on the 15th of February. You come back to your charts the next week on the 18th of February, and you're like, oh, I want to enter this trade. There's two indecision candles. Which one do I choose for my entry and my stop? I choose the one that has the lowest low and the one that has the highest high. So in this case, if I were entering on the Monday, I would no longer use the candle from the Friday. I'd use Monday's, if I was entering on the Tuesday, I'd use Monday's candle because Monday's candle closed like this. So this is Monday's candle, by the way. If I'm entering on Tuesday, which is this candle, I would use Monday's candle because it has the lower low. So now that becomes the lowest, that becomes a new low essentially. And I'd still place my stop loss there, and I'd still place my target ahead of the barriers. I wouldn't meet my minimum risk to reward ratio, so I just would not take that trade. Do you use trailing stops? Trailing stops are an advanced type of stop loss. I don't use trailing stops as provided by a Forex broker. You know, those automatic trailing stops trail me by 30 pips or whatever. Those are completely useless, and they're going to cost you more money than they make you. In my strategy, I just want to be clear. In my strategy, I'm not saying they're useless for other people's strategies. But for me personally, for my strategy, the way I trade, they're completely useless. They're going to cost you way more money than they make you. You're going to get stopped out far too often, especially in low volatility markets where price has a tendency to pull back a lot. So you enter short and you're going to see it pulling back a lot. That's very normal in low volatility markets. So your trailing stops are going to get hit quite often. The way I do trailing stops is by trailing. It's very hard to explain. So let's say I've entered this trade with 2R. 2R just simply refers to risk to reward ratio. So if your risk to reward ratio is 1 to 2, that's 2R. So I enter this trade with 2R. When it gets to 1R, so that's 1 times my stop loss, I'll halve my stop loss down to 0.5R. When this gets to what would have been 1.5R, had I left my stop loss there, then I'll take my stop loss to break even. So I'll trail it like that, but I won't use any kind of automated trailing software because it just doesn't really work that well. What time frame is the best? There is no best time frame. It's not on topic also. Greenheart, that's a very complicated subject, and I can't really sum it up in a Q&A at the end of a webinar, unfortunately. How do you know when the market will break through support resistance? I mean, there's a lot of kind of ways to sort of know it, but a lot of the times it's just going to break through them, and you can't do much about it. Should indecision candles be near support resistance? They need to be on top of support resistance, but again, that's off topic. I've done recent webinars on my strategy, so just check out the YouTube channel, the webinars playlist. There are plenty of webinars on my strategy. How to use multiple time frames because you're new to Forex. Sorry, that's not on topic. Not on topic, not on topic. Alan, that's a good question. It's very difficult to answer it in this webinar because it's, again, quite a complicated topic. But the short answer is that it's based on momentum. So if you're seeing a lot of momentum, what is momentum? Momentum is when prices. Wait, let me just read out the question for those who missed it. You mentioned moving down your target when the market is moving further down. Are you looking for specific movement prior to doing that? And where do you move your target to? So let's say my original target is here. And I see a lot of momentum. So momentum is a very big candle just pushing down very, very fast, especially as it's approaching my target. I might extend that target. I might remove my take profit and extend that target. Now, I'm not always going to do it. There's a lot more factors than that, but that is one of the factors that I would use. So when price is moving down or up, but in this case, because it's a short trade, down very quickly, I'll extend my target. But yeah, it's a complicated subject because there's a lot of different variables. For example, if you've got a situation like this where price is in a tight range, so this is a tight range here. When you look at what price is doing here on New Zealand CAD, it's in this range here. When price is in a tight range, you don't really want to extend your targets beyond that range because that range is a pretty powerful thing. And with a pretty good degree of accuracy that it's going to get stuck in that range. You don't want to place your target below it. But let's say we're going along. This is a good example here. Well, I'm not sure if it's a good example because I don't know if we'd be able to find an entry here. But let's just pretend that this was a trade setup here, which it wasn't, but let's pretend it was. Let's pretend we had a nice little indecision candle here. Just for the sake of this example, we're going to pretend a little bit. So, you know what? To help with the pretending, let me get out my drawing tools. We're going to draw a little indecision candle here. Okay, I can't use this tool anymore because my screen's frozen when I draw. So we're going to have to rely on just these drawing tools. So that's a little indecision candle sitting on top of support. Awesome. We have a nice setup here. Now, where do we place our stop? We place our stop below the low. Where do we place our entry? We place it above the high. Where do we place our target? Now, our initial target, we want to place it ahead of barriers. This is resistance. We want to place it here. Now, we see price pushing up quite fast. Not on this time frame, but on the daily. On the daily, it's pushing up quite fast. All right, so let's go back to the daily chart and we'll draw this candle in again. Nice little indecision candle. Our stop loss is here, our entry is here, our target's here, but it's moving really, really fast. Now, I would remove that target and I would extend it up to the next resistance area. Why would I do it in this case and not in the case of the range? Well, because when we look, what do we see here? We see this huge bullish trend. Price is trending heavily up. So it's not stuck in a range, it's in a trend. And when we're following the trend, it makes more sense to extend targets if we have momentum on our side. So that is a case where you would extend your target. I kind of just answered that. Nelson, for scalping, I do suggest a 1-to-3 ratio. That's correct. All right, guys. We're at 9 p.m. UK time. I'm going to call an end to this webinar. I am off tomorrow for snowboarding. It'll be a fun trip, I believe. First time I'm snowboarding. Well, no, that's not true. I've done snowboarding in an indoor slope for practice, but this is the first time I'm doing it on a real slope. There won't be any webinars next week, guys. But yeah, thank you for attending. I hope you learned something useful about entering trades, placing stops, placing targets. And I'm going to Andorra with a large group of people. So yeah, it's going to be a bunch of people snowboarding and a bunch of people skiing. And I believe it's going to be fun. Yeah, apparently it's going to snow when we get there, which is going to be great if the weather report is to be believed. But there's a lot of snow sticking around still. But yeah, I got an early start tomorrow, so I'm going to end things now. Thank you guys for attending, and I'll see you soon.